Hey, what's up? Welcome back to Dapper Dividends. I'm Russ, and I got a fun little exercise we're going to run through on the channel tonight. I have 3 dividend growth stocks that will pay you $25 a month every single month of the year. These are Dividend Aristocrats, meaning that they have been paying a dividend that has been growing its base for 25 years at least. And I'm going to run through some really quick analysis of each of the 3, and then I have a nice little chart that we will go through at the end to visualize and show you exactly how this will work. So without further ado, let's get to it. First up on the list is AT&T, the vaunted, loved, and hated dividend growth company. Well, they have till the end of this year to increase the dividend, or else they will be in jeopardy of losing their aristocratic status. So AT&T is the provider of telecommunication, media, and technology services. I think everybody is familiar with them. Last traded at $28.80 a share. Shareholder returns not looking very good over the last 5 years. With dividends reinvested, you would have received 4.9% gain compared to the market at 144.2% and 15% for the industry. They are a cash machine. I still like AT&T. I think they have a lot of good assets working for them, in particular the HBO Max. They are paying down their debt, currently spotting a shoddy negative 3.1% profit margin. But the main reason most people are buying AT&T is that booming 7 and nearly 1/4% dividend. Just a massive yield that AT&T's got going on there. Now, this is something that I like to point out. They show that their current payout ratio is negative 277%. Now, that is the earnings per share payout ratio, which has a lot of financial manipulation baked into it. So I look at the free cash flow ratio, and the free cash flow ratio is about 54.4%. So very, very stable comparatively, going off the free cash flow yield. And as you can see, the future is looking a little bit brighter, where they predict in 2024 it will only be 64% of free cash flow. So don't let that big red number scare you off. And the valuation, simply Wall Street basically looks 10 years out into the future and then discounts that back to a price today. That's why you see some really high valuations on some of their predictions. So here they have a $79.22 fair value, making them about 63% undervalued. Take that with a grain of salt, because up to this date, newsflash, nobody knows the future. Next up, one of my favorites, ticker symbol CVX, Chevron Corporation. I've stuck with them through the thin, and now I hope we get to bask in the glory of the thick. I keep investing in them, and they are the integrated energy, chemical, and petroleum operator that is worldwide and vertically integrated. As I have been preaching, they are involved in the exploration, pulling it out of the ground, the extraction, the shipping, the storage, the refinement, the processing. They're doing it all, the sales. They are fully integrated, full service. They are not just a drill and sell company. So this is the kind of company that I have all full faith that will weather these headwinds that do seem to be subsiding just a little bit in the oil industry. Last traded at $92.55, looking a little bit better than AT&T on the 5-year, a 31% overall return, blasting away the industry at only 3.4%. So Chevron, one of my favorites. Now, I could have went with ExxonMobil here, but I am just more confident in Chevron, and Exxon has a little bit of a debt problem, currently at a 5.9% profit margin. But as you can see, things are definitely starting to pull up, with those headwinds starting to taper off for the oil industry, we hope. And this again is something that I really love about Chevron, is their balance sheet. It is much more pristine than Exxon. $24 billion in short-term assets covers the short-term liabilities, and $198 billion in long-term assets to cover only $71 billion in long-term liabilities. The dividend yield is very nice. Remember, when the share price goes down, the dividend yield goes up, and when the share price goes up, yield comes down. So Chevron has had a really nice high dividend yield that I have been taking advantage of since the March market crash. Negative 174% earnings per share payout ratio. Now, remember where AT&T was high. This is actually much worse. When I calculate the trailing 12-month free cash flow ratio, it is actually 570%. That is no bueno, but they have a lot of cash. They are able to sustain this through debt. They've been here before. Check this out. In 2019, the free cash flow ratio was 68%. It was 50% in 2018. And in 2017, it was 114% of free cash flow. They've been here before. They can handle this. Let's check out the valuation. We see that they have a $113.91 fair value on them, making them about 18.7% undervalued. Yeah, check that out. Last but not least, one of my favorites, ticker symbol KMB, Kimberly-Clark. I did not start buying them until the collapse in March. I'm so glad I did. And just looking at that picture of the Huggies logo, boy, do I love that. That gives me the warm and fuzzy feeling because there's always going to be babies. People are always going to need to be wiping butts and blowing noses. Kimberly-Clark is going to have a place in this world, helping to make the world go around just a little bit cleaner, safer, and neater. So they do manufacture and market personal care and consumer tissue products worldwide, such as Kleenex and Huggies. Last traded at $132.13, and 18.6% 5-year return with dividends reinvested. That has underperformed the industry and the market, but I still love Kimberly-Clark because I'm buying it for that dividend, and currently sporting a very nice 12.3% profit margin. That means out of every $100 that comes back, they're keeping $12.30 as pure profit. Their short-term assets do not cover the long-term liabilities. They do have a little bit of debt, but last October, they did acquire Softex Indonesia, which is one of the largest diapers manufacturers in Indonesia. So that is going to help them grow. So yes, they took on some debt, but it's productive debt, and $12.35 billion in assets, which does cover the long-term liabilities. Now the dividend, I love them. 3.45% for a big blue chip company. That's very nice to see as a starting yield. Their 3.5% does outperform their industry, so very nice, and it is almost at the market top 25 of 3.8%. Love me some Kimberly-Clark. The current payout to the shareholders is 62% of earnings per share, and the free cash flow ratio is 57.7%. Any way you slice it, that dividend is very safe, healthy, secure. It's not going anywhere, and they have room to keep growing that in the future. And the valuation, given a $153.18 valuation, currently at $132.13, it is 13.7% undervalued, and Kimberly-Clark, you'll always be undervalued to me. And check it out. Here it is, the $25 a month in dividends visualization breakdown. 49 shares of AT&T, currently at $28.80, would cost you $1,411, would pay you $25.48 a month, and $101.92 a year, pays you in January, April, July, and October. 20 shares of Chevron, ticker symbol CVX, $92.55, would cost you $1,851, would pay you $25.80 a month for $103.20 per year. Pays you in February, May, August, and November. And 22 shares of my favorite, Kimberly-Clark, ticker symbol KMB, $132.13 current price, $2,708.86. That would run you. Pays you $25.08 a month for $132. No, $100.32 a year. Pays you in March, June, September, and December. That would run you $5,971.06, but you would be getting $305.44 of dividends per year. Divide that by 12. You got your $25 a month. If you would like to support me in this channel, please, I would thank you to gently tap the like and subscribe button. Don't smash it. We don't want you breaking things. We don't believe in violence around here. Follow me on Twitter at RustyRam78. I'm on Instagram at Dapper Dividends. I don't sing there, but I do a little bit of singing here because, hey, why not? Life is short. I love it. Be you, be yourself. Be bold, brave, beautiful, and not bashful. I couldn't think of another B word off the top of my head. Belligerent, beautiful, bashful, whatever you want. Anyway, I'm going to get out of here. Got a little bit of editing to do to get this thing out. Thank you for spending a little bit of your time with me, and I will see you in the next video.